Hello and welcome to the conversation with Dr. Joseph Thomas, Head Research, Emkay Wealth Management. Today we'll discuss key topics like inflation, interest rates, and equity markets. Thank you for joining us today, Dr. Joseph.
Thanks, Ashwini. Thank you very much.
Shall we begin?
Yes, sure.
The Indian rupee has been sliding and now it's close to 86.60 levels. This is concerning. What are your thoughts?
Yeah, there is a context to the rupee depreciation. The context is that if you are looking at the emerging market currencies, almost all the emerging market currencies have depreciated by about 4%. And if you take a look at Latin American currencies, the depreciation has been to the tune of about 5%. And during this time period, the rupee has been more or less stable and there was not much of a movement. That's the first aspect of the context. During this time period, the US dollar appreciated by about 5%. That's the first aspect of the context. A second thing that we need to look at as far as dollar rupee exchange rate is concerned is the real effective exchange rate of the Indian rupee. The real effective exchange rate measures the strength or weakness of the Indian rupee against a basket of currencies. The real effective exchange rate was at around 107.90 and 100 is considered to be the neutral level. Beyond that, 107.90 was the real effective exchange rate of the Indian rupee against a basket of major currencies or its main trading partners. After the recent fall in the Indian rupee against the US dollar, the real effective exchange rate has now come down to 103.5060, which means that the depreciation that has happened recently is to the tune of about 3.90%. So in terms of real effective exchange rate, the rupee was overvalued and the rupee has now found its natural depreciated level at around 86, 40, 50 or 60 as of today. In this context, one of the inferences that we could make is that the rupee has finally depreciated by a certain percentage because the rupee's average level of depreciation has been anything between 3 to 5%. So rupee has actually done a catching up with the emerging market currencies depreciation and catching up with the depreciation in the Latin American and African currencies. So at this level, it looks like it may remain somewhere around these levels, or at worst, what we could see is that it could maybe test levels like 87, 20, 30. That's not very far from the 86, 50, 60 levels. Now, what gives strength to the rupee, the Indian rupee, or what makes it weak is two things. The first thing is trade. The second is investments. As far as trade is concerned, we are always net importers. And net importers means we are net buyers of dollars all the time. So trade is not going to help us at least for another 5 years or 10 years as far as rupee's strength or weakness is concerned, because we are net buyers of US dollars. Coming to investments, what is important for us is the FII flows into India or FII flows out of India. As you all know, we have seen FII exits from the equity markets, and those exits have naturally led to some amount of sell-off of the Indian rupee against the US dollar. Only in case if we start receiving some inflows from abroad, like FIIs coming back, we might see some strength coming into the Indian rupee. And I must add here that as far as the RBI is concerned, RBI's approach is that if the rupee depreciates in a gradualistic fashion, in a gradual way, if the rupee depreciates, I don't think RBI has anything against it. RBI will intervene only if it feels that there is a kind of a speculative attack on the Indian rupee. Though RBI had intervened in the last couple of months to stabilize the dollar rupee exchange rate by supplying dollars to the markets. So the movement that we have seen in the dollar rupee exchange rate is quite a natural thing against the appreciation of the dollar to the tune of about 5% and the depreciation of emerging market currencies to the tune of about 4%, Latin American and African currencies to the tune of about 5%. So the rupee is just doing that catching up work. That's it, and we do not see very any further depreciation in a very swift manner. Though the rupee could slide further based on the currency flows and the demand and supply of dollars.
Dr. Joseph, the outlook on inflation is currently clouded by food prices. To add to that, the fuel prices are doing no good. My question to you is, this outlook, will it guide the RBI policy?
Yep. If we look at the inflation numbers, we have seen inflation coming down, and it did go down to around 3.5%, then it moved up even beyond 6%, the headline inflation. Recently, the last number was at around 5.22%, the CPI headline number. What had influenced the CPI number in the last few months is actually the prices of onions and prices of tomatoes and some other vegetables. It was these prices which pushed up the headline inflation and the food inflation especially, which touched almost 10.90%. Food inflation has now come down to around 8.5%. The prices of onions and tomatoes have come down. After the winter, after good monsoon and after the winter, we have a very good supply from the crop of fruits and vegetables now. And we do not expect any flare-up in food prices at this juncture. Any supply-demand imbalances in certain items of consumption may be neutralized over a period of time by improving the supply of those goods by the government or governmental agencies. Therefore, the food inflation, which was actually on account of the prices of specific vegetables or items of consumption, need not necessarily be a cause for worry. The second factor is fuel inflation. As you may know, the Brent has been in a range of say 72 to 76 most of the time in the last 3-4 months. Recently it moved up to around $80 to $82 per barrel. We do not expect any major spike in Brent prices, mainly because of two sets of factors. The first factor is that the demand from China, on account of a slow economic growth in China and on account of the increased acceptability or use of EVs in China, Chinese growth has been sub 5%. Therefore, naturally, demand for oil would also be quite low. So, Chinese demand coming into the global markets has been much lower compared to what it was in the last few years. and the assessment of growth in global demand given by international agencies is also a very marginal growth in the demand for oil. The second thing that we need to look at is that a country like the US has entered into a phase of record growth in their oil production. The US production of crude oil moved up to 13 million barrels per day. This makes the US quite self-sufficient in terms of their oil requirements and fuel requirements. A third factor that you could look at is the conditions which have been there in the global markets and also in the geopolitical sphere. We have had the Russia-Ukraine conflict and also the Middle East conflict and also output restriction by OPEC+. Despite all these factors, the price of Brent didn't move up much. It has been in a range of 72 to 76, and right now it has moved up to around $80 per barrel. Therefore, despite these adverse factors and conditions, oil prices didn't move up much. But as far as India is concerned, there could be a slight issue with respect to the dollar-rupee exchange rate, because rupee has weakened, and that could make our imports slightly more expensive. But I think overall, the international prices, Brent, in the global markets could remain more or less stable at this point of time and range bound. Maybe the broad range which we had defined in Emkay Wealth Navigator in the last 3, 4, 5 months is $75 to $80 per barrel level. So there is not much of a threat as such coming from food inflation or fuel inflation at this juncture. Therefore, I don't think, we don't believe that these two factors would be, could put some pressure on the Reserve Bank of India on a rethink of its monetary policy in the other direction.
Very interesting point now is interest rates and market yields. They have moved down in a year or so. However, this growth has been stalled now. Some of my investors who have invested in bonds and gilt funds, there's a disappointment in the market right now because they are not being able to get the expected returns. When do you think the market yields will go down?
It's true that investments into gilt funds or investments into Government of India bonds or even corporate bonds or bond funds haven't yielded the desired results. That is, initially, when we had recommended gilt funds and bonds, it was based on a number of factors which were favorable for movement of yields southwards. So, for example, the Government of India borrowing program for the current financial year is much lower compared to what it was last financial year, to the tune of about 2 lakh crores. Therefore, there will be less supply during the course of this year, and whatever is less in supply and which has a constant demand would appreciate in value, and there is good demand for Government of India papers from insurance companies, provident funds, banks, financial institutions, and also investors throughout the year. That is the supply factor. That was one of the reasons why gilt funds or bonds were all recommended to investors. A second factor is that the index inclusion of Government of India bonds in JP Morgan index fund and other indexes has actually led to inflows into India to the tune of about approximately 12 billion US dollars equivalent of funds have moved into India and invested into Government of India bonds. And this is for the first time in our history that overseas funds have moved in a big way to remain invested in Government of India bonds. The total funds which we had expected to move into India is close to around 25 to 30 billion US dollars, based on the 250 to 300 billion quantum of funds which track the JP Morgan index. So part of that has happened, which is to the tune of about 10 to 12 billion US dollars. The rest of the amount, about 10 to 15 billion US dollars, is yet to come in, which means that some amount of demand has already come in and there is more that's going to come in. So the lower government borrowing program and the JP Morgan index inclusion have been the two strong factors based on which initially we had recommended gilt funds and also bonds for investors' portfolio. The final thing or the final act from which the markets could benefit is a repo rate cut from the RBI and injection of liquidity into the system. RBI has already started liquidity infusion into the system. RBI has already cut the CRR and injected into the system about 1.15 lakh crores. And RBI has already started the variable rate repos, through which they would again inject liquidity into the system. And RBI could also be coming into other forms of open market operations to inject rupee liquidity into the system. RBI has taken away from the system quite a large amount of money on account of the dollar rupee intervention in the last few months. So in our assessment, RBI is likely to cut the repo rate and infuse liquidity into the system in the coming 2 or 3 policy meetings of the RBI. Because economic conditions, the market conditions are stable, the threat of inflation, of course, threat of inflation will always remain there, but in all assessment, inflation could moderate from these levels. The next CPI, headline CPI number could be much lower. The next 2 to 3 inflation numbers could be much lower from the last number that we had. And we expect the RBI to act quite fast on the rate side and cut the repo rate and also infuse more liquidity into the system. I must admit that the gilt yields and gilt markets and bond yields have been and returns have been quite volatile. But the view that we had shared with investors has been that whatever you allocate today is a kind of a tactical allocation that you are doing for the next 12 to 18 months. And I would also like to tell the investors that when you invest in fixed income, the least or the worst that you could get is the coupon that accrues on the portfolio or on the bond that you buy into. Therefore, there is a coupon accrual, and the minimum returns that you could expect from, or the worst returns that you could expect from such bond investments or from gilt fund investments is something, will be something equivalent to what you get on an overnight fund or on a liquid fund. So the view actually would pan out over the next 6 months to 8 months and closely linked to the interest rate action, the repo rate action which the RBI is likely to take. Now, in line with the US markets, especially US Treasury yield movements, even our gilt yields and all moved up sometime, then they came down, then they moved up again. So there is some amount of volatility, and we need not be nervous about these things or look at these movements on a day-to-day basis. Our target is to realize a good return over the next 12 months to 18 months, as this is a tactical allocation. So even at this juncture, with portfolio yields close to 7% on gilt funds and around 7.5%, close to 7.5% on corporate bond funds, we still recommend to fixed income investors and investors who would like to or investors who would prefer fixed income investments to look at these funds. And we continue to recommend these funds, and we suggest that you stay invested for maybe, if I may mention, even the returns may be a high single digit or a low double digit returns over a period of time with RBI rate cuts. But we need to see the RBI rate cut taking shape, and RBI infuses more liquidity into the system.
Dr. Joseph, equities have come down and people fear, which is quite natural, it may fall further. At the very same time, the markets have become attractive to buy. We need to quell this fear for my investors who are into investing into equity markets. What is your guidance on this?
Yeah, equities have come down. Earlier, you mentioned that gilt fund investors haven't got anything much.
Yes.
So let me tell you that the gilt fund investors are getting at least 2%, 3%, or 4%. They should be happy. And for the last 3 or 4 months, what the equity investors got is a negative return. The large cap index returns is in the last 3 months is close to minus 6%. The mid cap returns at around minus 7%. And the small cap index returns is somewhere at around minus 8%. So it's negative there. Now, why it is negative in the last 3 months is because there is a normalization of returns that has happened in the markets. We had seen returns as high as 35 to 40% in large caps, around 55% in mid caps, and around 65% in small caps. Though such high returns are not sustainable, it means that there should be a process of normalization that should happen, and that is happening in the markets. Therefore, we should be comfortable with the current levels, because if you're looking at the 1,500 to 2,000 stocks listed on the stock exchange, they have lost altitude to the tune of about 20 to 40%, which means that quite a significant amount of correction in prices has already happened in the markets. And that should enthuse us to invest more and stay invested in the markets, and also invest more, because markets have become much cheaper. Now, there are 2 other factors which do play a role there in addition to the need for normalization. The first thing is that we have seen the GDP growth slowing down to 5.40%, as against an estimated annual GDP growth of around 7 to 7.20%. Now the GDP growth for the current year is placed at 6.4%. It means that the GDP growth has slowed down, and in this slowdown, it has some impact on corporate earnings, and we have seen the earnings results and earnings growth not so impressive. If you're looking at the last quarters and the current quarter, it may not be very impressive or in line with the market expectations. So GDP growth has slowed down, and the government measures, mainly through the budget, the RBI measures through the monetary policy announcement, both of which are due very soon, should give a push to the markets. That's one of the things that we are expecting. Also, if you are looking at the public capex, or the public capital expenditure of the government of India, which was provisioned in the current year's budget, was at 11.10 lakh crores. And only about 50% of that has been expended by the government of India up till today. It's very important that the public capex is undertaken in a more aggressive fashion to give a push to the economy so that the economy realizes a much higher rate of economic growth. But there is something which is quite comforting, that most of the forecasts from the markets as also from the RBI, they have put the GDP growth for the current financial year at around 6.40% to 6.5%. So it's not a very major deviation from the originally projected rate of economic growth. Yet another factor that we should look at is that the FIIs have been continuously moving out of the domestic markets, and they have been moving out mainly from the large caps. In the second round, in the next wave of the FIIs coming into India, that could be after Fed would cut interest rates at least by another 0.5%, because they have cut the Fed funds rate by about 75 basis points in 3 installments. We expect the Fed to cut interest rates further, though there are forecasts across the world from economists and analysts that Fed is not likely to cut interest rates further. But the economic conditions warrant further cut in interest rates. The headline CPI is less than 3% there. The core inflation also has come down in the US. In the US, the cost of funds is at this point of time is very high, especially when you consider mortgages and mortgage rates. There is a need for that to come down. And anyway, in the next few hours, Trump is going to take over. And during his last tenure as the president of the US, more than 2 or 3 times he had requested the Fed to cut the interest rates and make the cost of credit much cheaper. Therefore, we expect the Fed to cut interest rates further. The RBI would also cut interest rates, and therefore the cost of credit could come down with more liquidity and lower rates. At this point of time, the strength of the domestic inflows is quite good. It's at around 25,000 to 26,000 crores through SIPs, through mutual funds into the equity markets. We believe that these inflows will continue to be there and that this liquidity support will strengthen the markets, and even if the markets would dip slightly lower from here, a lot of buying would come in, and it's only a matter of time with rupee depreciation and much cheaper valuations. It's only a matter of time before even overseas investors would move in. And that's the time we will see the markets doing much better. But the current situation, when the markets have cheapened up, should be utilized as an opportunity to invest into the markets and build the portfolio.
So, Dr. Joseph, now I want to ask you, which are the preferred segments or sectors clients or investors can aspire to be in? Can you throw some light on this?
Yeah. If we go by the highest rate of growth, or the potential for growth and potential for price performance, it's mid caps which would hold a better promise. That's the mid cap segment. And in the next round of FII inflows into India, we expect quite a significant amount or percentage of funds to move into the mid caps. That's mainly because of the potential for growth and performance which is highest in mid caps compared to even large caps or small caps. A second factor that which gives strength to mid caps and also small caps is that the market capitalization of the companies in these two segments, mid caps and small caps, their market caps have gone up, which means that it would give a considerable amount of comfort to overseas investors and also domestic investors to look at mid caps or even small caps as a critical destination for their investments. This comfort was not there earlier because the market caps of small caps were too small, 850 crores or 1,200 crores or 3,000 crores. Right now, it is anything less than 33,000 crores is small cap, anything above 33,000 crores to 99,000 crores is mid caps. The market caps have actually expanded. So therefore, if they bring in 2,000 crores or 5,000 crores, they can easily deploy that because of the higher market capitalization. Therefore, on a market cap preference, this would be the preference, say mid caps first, then we have large caps and small caps. Coming to the sectoral performance, from Emkay Wealth Management, we have laid a lot of accent on funds from infrastructure and public PSU equity, which we have been highlighting to investors because in infrastructure, we have seen consistent growth and price performance over the last 3 years or 5 years in very good infrastructure mutual fund portfolios. So, with the government budget now going to come up and the government's continuity in policy and continuous accent on policy measures which will benefit the infrastructure segment, we believe that the infrastructure could do very well. Also, infrastructure as a sector, its performance is not very closely linked to economic growth and economic cycles because it is an activity which has to be on all the time. And the current government's accent on this sector is very good. It is unlike any other government in the past, and we should capitalize on that. And infrastructure funds is an avenue that we recommend to investors. Yet another area where we would recommend investors is where a lot of normalization has happened is the PSU equity space. We are recommending the PSU equity space because there also we have seen a significant amount of normalization that has happened in the returns and also cheapening up of the stocks which are there in these portfolios, and they look cheaper to buy, a good buy. Therefore, infrastructure, PSU, equity are two themes or segments that we would recommend strongly at this point of time.
Finally, gold and silver. Where are they headed?
Gold is at around 2720 levels. Gold is well positioned to do well. And as far as domestic buyers are concerned, it translates into a very good rate if because of the dollar rupee depreciation. The target on gold still remains elevated towards 2780 and 282030 at this time. On silver, it's close to the 33 levels at this point of time in global markets. 33 to 34 is a significant level of resistance before it moves to its all 35 is a 52-week high. So between 33 and 35, silver will get resisted to some extent. But some of the forecasts, because of the increasing industrial use of silver, there are very aggressive forecasts which put the price of silver much higher from the current levels towards the 40 to 45 range. But it's a tall order for it to move that much, but markets could move that much also. But the essence of it is that the view on both gold and silver is quite bullish. Now, what could actually help gold and silver is not war or inflation or even industrial use. It is none of these factors which are going to ultimately support gold prices and silver prices. The factor which supports gold and silver prices is a likely depreciation of the US dollar. The US dollar appreciated in the last 3 to 6 months by about 5% because US interest rates have been more or less stable. Overall market yields haven't come down much. On the contrary, they moved up a little bit. The dollar index also moved up. So we need to see a gradual depreciation of the US dollar before we can see a more aggressive rise in the prices of gold and silver. But for investor portfolios, I would always suggest that some exposure, maybe 5%, 10% of the portfolio, some exposure to gold or silver through gold funds or silver ETFs is something that could be looked at.
Thank you for your invaluable insights on the financial markets. Dr. Joseph, wish you and our audience a spectacular and successful 2025.
Thank you very much.